All right, everybody. Hey, we are back for our next amazing rock star here on Note Camp 2021. This guy spoke last year and was one of the highest rated speakers because people loved what he brought to the table and shared as far as content. Now, we all know that it's been a crazy, chaotic time in COVID on the residential side, but also on the commercial side. And I've been saying for a while, I think we're going to see more commercial debt sooner than we see a lot of the residential stuff out there. And so honored to have the founder, co-founder, and the head honcho, I guess you could say over there, the head bottle washer, a guy who's been trading in debt for, I think, for over a decade now, for the most part. We're pretty damn close to it. My buddy Michael Jimenez. What's up, man? How's it going?
Hey, thanks for the great intro. Wow, the pressure just spiked, man. I didn't know I was that highly rated. I would like to say under a decade, so I appreciate the compliment. But yeah, it's I started in CRE back in I think 2003, 2005 when I graduated school. I was doing intern stuff before that. But yeah, it's been a while, and I've been focused on the distress side since about '08. So
Nice.
I've learned a few tricks along the way. We started off on our own about 7 years ago now. So while the origination and upcycle is still kicking, and we started Exchange.Loans just about, I want to say, a year ago officially, but we've been working on it for some time and building it ourselves with the latest greatest in tech. So check it out, Exchange.Loans, the online marketplace for non-performing loans, and that's what I'm here to talk about today. Yes, I agree, Scott. We're likely to see some commercial distressed asset opportunities, especially where we are in the cycle. I'm going to cover that all once you advise for me to share my screen here.
Go right ahead, brother. Hit the share your screen, and then there we go.
Houston, we are okay for launch.
There you go. Just got to
And you guys can
maximize
see
that.
that.
Yeah.
Maximize here.
Look at you. You even got the
Okay,
logo.
perfect.
Yep, there you go.
Well, now that
you want to take questions throughout, or you want to wait till the end for them?
I would love interrupt me as much as possible. I have a tendency to get bogged down in minutia and go a little fast. So feel free to interrupt me. I like the more dialogue because there's so much to cover. And I kind of focused on trying to stay or build on top of what we went over last year, which was just like a quick crash course. So this will get a little bit more into, I guess you can say, the strategy and tactics that I use and that I've been refining over the past few years to find CRE Mpls.
I love it. So I'm going to drop off my video, but I'm here, man. Okay.
I'm here. All right, you got it. Thank you. So without further ado, and again, if anyone, Scott, feel a need to or urge to ask a question, please feel free to just stop me. Okay, so here's the intro: how to source, buy, and sell CRE Mpls for the We Close Notes No Camp 2021. I'll start off with a quick intro and background just on myself and the company, Exchange.Loans, that I started and helped run. And then we'll just go over briefly distressed debt market, kind of the cyclical nature, where we are, current market trends, and just touch a bit on the distress process, just to make sure that everyone's like keenly aware kind of where things are. Then we're going to look to focus on just the real basic fundamentals of sourcing commercial real estate non-performing loans, then buying them and selling them. So I want to get right into it. And again, if at any moment you guys have questions or have any insight to share, feel free to chime in. And if we get through all this quickly enough, we also have some case studies, or we can just take questions. So plenty of stuff to cover today. So speaker and company intro. So this is me, Michael Jimenez. I'm the CXO, or Chief Experience Officer, and co-founder of Exchange.Loans. Basically, we built a tech-based or SaaS-based marketplace to help lenders and investors buy and sell loans. Our focus is non-performing loans, but we can sell performing, sub-performing, etc. We don't do originations, and we really do focus on sales, and mostly having an open listing platform that's both secure for both the lender and investor. Okay. So distressed debt cycle. I think we're a bit further along in the cycle than we were a year ago. We're still relatively in the, I would say, like same sort of early innings of any sort of down cycle or recession. More importantly, I think the key things to remember here is one, this is a cyclical market, both on the consumer and commercial real estate and finance side. Four main stages: recovery, expansion, hyper supply, recession. I would focus on hyper supply. I think that's where, if we're somewhere between stage 3 and 4. I think we're still in the hyper supply, and you might be able to, and that leads me to step number 2 here, hyper supply. It's not so much with the product or inventory of the real asset, right, of the homes, which we know they're saying there's a shortage for demand. We're really in a hyper supply, I would say, of excess liquidity. Rates are at or near historic lows. There's been a lot of pent up demand for homes, and as well as multifamily. And like Scott alluded to, we are beginning to see sort of, I guess you can say, cracks in that cycle of just go baby go, right, to infinity and beyond, or to the moon, as they say with Doge. We're seeing it in a lot of asset categories, but primarily it's all there because of the excess liquidity. Leverage for commercial mortgages was pretty high prior to the pandemic. It's probably, I would say, higher now, by all means, especially as it relates to, I guess you say, federal intervention in the marketplace, right, with the moratorium, et cetera, et cetera. So everything's just pushing for a hyper supply of credit and pricing to continue to increase for commercial real estate, which leads us to the opportunities. Liquidity is being taken back and credit is being tightened for certain aspects, and it's typically the ones that are performing, I guess you say, performing worse than most other property types in response to the pandemic, primarily in terms of loan types: CMBS debt, bank debt, small balance lending or small balance loan debt, and then commercial and industrial. In terms of commercial real estate property types, hotel right now is the number one loser, I guess you can say. Retail, retail apocalypse started with online retailers a while ago now. They kind of never really came back with the same strength as they had in 07. You can see that with the mall is kind of like the textbook example, as well, just the retailer balance sheet and how many retail bankruptcies we've had. So they've been it's been tough for retail for a while. A lot of that, the less competitive space and less functional space kind of got taken out over the last, I'd say, almost 10 years now, over 10 years. But now this just kind of hit them even harder. So you're starting to see a lot of, I think Starwood just announced that they're going to start dumping malls. So we expect, and not me, but the underwriters and the analysts expect 2/3 of America's malls will eventually be closed within the next 10 years.
So that brings up a good point, Mike.
Yeah.
With that, what do you, and you may not know the answer to this, but you figure what's the average UPB on a mall right now? I know we got some big ones like Mall of America there in Minneapolis has been for years, but then you also look at like small malls in the area, like Simon Malls obviously been hit big hard. That's here in Austin, and I think they've also got some stuff in like the Florida mall, stuff like that. But 2/3 of all malls going away. That's a direct impact not only of the distressed debt, but Amazon obviously too. And everybody's shopping online, right?
Yeah, it's funny because and I like how you ended with Amazon, because we kind of come full circle. The thing that really determines the value on those and the debt, it's not, they're not going to be able to pay it back. I would say average is probably going to range from about, you're talking 10 all the way to 50 million for most of the mid-tier, class B and class C malls that maybe have already lost all or a portion of its anchors and it's just hanging on by the thread, or what do I call zombie malls, right? You have the dead malls, which we all seen the picture where the weeds are growing up from the escalators, right? And then you have the zombie malls where you're just like, hello, like, is there anybody out there? There's no one really there. But yeah, typically 10 to 25 million for the stuff that's already kind of in the tertiary markets and not doing so hot. For the stuff that's still active, or even close to having some semblance of equity, you're typically speaking 25 to 50 million up. But so thank you for chiming in on the malls there. I think that's a really interesting category.
It all depends on what can you convert it to too, because you can pick it up cheap, but what the heck can you convert it to, right?
So we've seen two recent instances where Amazon is actually testing to convert it into fulfillment centers,
right?
Which is kind of mind-boggling. But they have the deals. I didn't shop at Whole Foods before Amazon took it over. I do now. Not just because I'm a tech founder either. It's nothing like that. It's just they have good deals, so it's really interesting. But yeah, they'll typically convert it to mixed use office. Some of the more competitive malls, like where we're from, the Aventura Mall, they can add and expand actually because there's just
Yes.
enough demand, liquidity, and retail traffic, right? Some of the others that if they're located close to highway, Amazon fulfillment center or potentially multifamily, something like that.
Sure.
Make sure I pay attention. Gwinnett Place Mall has been distressed for 10 years. They just sold to the Urban Development Agency here in Georgia. Yeah, very familiar with Gwinnett Mall. Worked in Sandy Springs for a while. That's from Tyshawn Williams. So yes, some of them are going to keep hanging on. Maybe you can add some apartments to it. Maybe you can add a medical use or just take over some of the anchor space. But it's mostly about filling in all that inline space with with the highest and best use. So there's a ton of potential for the malls, and I do think in a lot of aspects, its success or its future is going to be determined by the folks in charge of zoning and as well as taxes in that jurisdiction. But
Wow.
that's it for on retail. Obviously, if you stayed open during COVID, and if you're selling masks, you probably got a smoking hot retail deal. SFR is a new product type. Came out. Invitation Homes invented in 2011. We've probably got about 10 billion of SFR has been originated and or securitized. We're actually in charge. I don't want to say in charge. We kind of have the I guess you can say we staked the claim to selling some of the SFR out of securitization for the servicers, and that's been really interesting, as well as small mom and pop multifamily housing. Those are the folks who maybe have been affected or had loss of employment due to COVID. Maybe they get back to work, maybe they don't, and we're also seeing the eviction for tenants or owner occupants still being delayed, or the rollout or continuation of evictions and foreclosures is still being slow to roll out. So a lot of stuff going on there. Hotels and retail are in it right now. They're making a dash for the exits. If there's any equity or perceived equity or potential for short sale or deed in lieu, they're looking for ways out. They're getting rocked really hard. And then we're seeing a slight uptick in second liens. And like I said, relating back to hotel and retail, you're going to see the opportunity for short sales. So if you're looking, and this will segue in the fourth part, if you're looking to get into loan sale advisory, whether full-time or part-time, or looking to get into buying and selling notes, and you just want to do your research, now is a great time to do it. I would start, you can look at probably short sales. And that's a really good segue in between traditional sales, investment, and brokerage, even leasing, and getting into, okay, so this is how it actually works before it's REO. So, and that'll go into the next section here. But that also brokerage versus LSA. If you want to be like me and and go LSA full time, it was a hard decision for me to make, to stop like chasing mortgage originations and stop chasing investment sales opportunities, and saying no to all that stuff and just focusing on this because I wanted to be ahead of the curve. And it took a really long time to really build those skills and those relationships and knowledge of those processes, which we'll continue to cover here today. Oh, and here's just some color into the size of the market here. So it's pretty large market. Trying to skip slides here. So here are some of the most recent trends. Like I said, we're in that hyper supply phase of liquidity. I'm just paying attention here. LSA is a loan sale advisor. Loan sale advisor. Guys, I love these comments. This is super helpful. Loan sale advisor. So, and it's different from being a broker. Thank you, Scott. Different from being a broker. There's really no licensure requirements or anything like that, so long as you're focused on commercial, like myself, and not owner occupied. So you can also decide for yourself which one do you want to focus on. So like I said, we're in the hyper supply of credit. If you can see here, this loan origination chart, this is from the Mortgage Bankers Association. They're probably the top notch in terms of commercial real estate finance, as well as real estate finance. There's no one source for all things regarding CRE and finance, but if there were, I would lean towards the MBAs. Definitely in everyone's top three: MBA, commercial real estate finance, or CREF, as well as TREP. Those are probably the three main data sources for commercial real estate finance. So loan origination, three main takeaways here. Number one, it's hitting all-time highs in certain regards. Number two, banks being part of that. They recently hit 1.5. This is in billion, so about 100 and looks like 70 billion in originations. And right now they have 1.5 trillion in total holdings, or 39% of the market for commercial real estate, as well as multifamily housing. If you see during the last downturn, see this purple drop here, that's CMBS, and as you can tell, it never quite recovered. It's about half of where it was in 06 and 07, leading into the downturn when they were, kind of persona non grata or main culprits for that. So they've only come back half, and they've really focused in that hotel, the secondary retail, as well as office. So some of those malls like Simon Property Group, those are the type of things that are in there. So and then they're kind of leading the way in terms of distressed assets. The GSEs, which is really interesting, they're they were considered a lender of last resort. They kind of bailed out the real estate market after the downturn, but they just continue to grow, and they're at about double where they were when the downturn hit. So they were at they were at just under 50 million, and now they're about 5x. Sorry, so they're at about, call it 25, 30 billion in originations, mind you, back in 05 and 06. So that's annual, up to about 150 billion in originations now, which is pretty incredible. So banks are going to be playing a higher role or larger role in CRE and multifamily distressed, and just originations in general. The GSEs that's completely multifamily, everything multifamily. So it's very focused. So they kind of trump everybody else in overall or that specific niche. And then CMBS is it's the same story. They're just not as big, which is probably a good thing. No offense to any CMBS lenders out there. These are the current delinquency rates, and these go way back. You can see here's kind of the mean or the norm here, that sweet spot between, obviously 0%, knock on wood, no one has 0%, right? But typical delinquency rates are 1% to 2%. That's a healthy, vibrant economy. Everybody's able to pay, and people are kind of hitting their mark in terms of growing, expanding, and staying current with their business and their debt obligations, right? This was obviously during the downturn, and this was the brunt of it here. And if you see, right, and this is something I really wanted to bring into focus here. Probably help if I had a marker or something on this, but I think everybody can bear with me here. So we all know, the mark kind of all the ticks in the roller coaster kind of stood still in about 2007, late 2007. I would say about around second or third quarter. And then we had the Lehman collapse in 08. So it took about a year for the roller coaster to kind of start going downward. And then you can see that in that spike, right? That's the spike in CMBS. Then we got banks and FRIS, the GSEs, Fannie Freddie weren't as big back then as we showed back here. But it took a while to hit bottom, to peak for delinquencies, right? That's 2012. So Lehman collapsed in 2008, and then we didn't hit the peak of delinquencies till 2012, and that's, with a lot of maturities and things. It takes a while for it all to get through the system. Right now, what we're seeing, and also the main thing with the delinquencies is you got a lot of forbearances, instant modification, instant forbearances, a lot of people with borrowed funds, stimulus, PPP loans, all of that is in here. So obviously we're not as high as we were back in 2012. Again, it took 4 years to hit that bottom. So we had, call it the lockdowns in 2020, about a year until we hit insolvency, or, everybody ran out of borrowed money, and now we're going to reopen, right? What happens next? I don't know. But I don't think, Scott, if you want to interject, please.
No, I think part of what you're talking about is that Lehman, I think, drug it out a little bit, was the bankruptcy by Lehman, and that kind of drug out as they kind of worked through that. Because I remember I had a couple of loans of the Aurora Loan Services back in the day, which is owned by Lehman, and couldn't do anything with them because they were going through the bankruptcy filings and stuff like that. So I think we're seeing a little more impact because there's more stuff's been financed by the banks these days versus your Wall Street, and your local mom and pops was what I think finance 66% of the stuff that's 5 million or less versus the big guys and stuff. So it'll be interesting to see what happens. If money keeps staying cheap, they can keep kicking the can down a little bit of road. But I think with inflation starting to increase
Yes.
and employment struggling, those are a couple other things that are going to affect, if you got a spot and location, great, but it doesn't mean you have anybody showing up to work it. You know what I mean?
Yeah, absolutely, absolutely. That's really the perfect economic analysis. I didn't want to get into that because I'll go down that rabbit
That's
hole
a
all
rabbit
day.
hole for another day, brother. Yeah.
But yeah, the main thing, this is kind of still crucial. I mean, it's a bit higher than the all-time lows, but we don't really know what these numbers are yet, and it's going to take a while to work out. So that's the main thing. And if you're looking and you're tuning in, it looks like you have quite a bit of an audience. So thank you for having me again. But you guys you're looking at the right place at the right time. And it is a really unique market out here right now, and I'll get more into that in a little bit, where that translates to the finding opportunities and buying and selling. But don't pay so much attention to DQ status because that takes a while to get there. That's part of the process of the distress process. It's a lot more about these late pays, and this also have those folks who are recipients of deficit spending, right? So CMBS, this is 30 plus days, so that's everything that's late basically. You can see the spike. I mean, you're talking 10% at the height of or the beginning of the lockdowns, and now it's still about 6%. And that's with those triple P funds coming in. So man, yeah, hotels, CMBS hotel loans. If I had to go after one specific loan type, that's probably where you're going to find the most amount of distress. Like I said, most of those guys are listing their assets on 10X and with their commercial real estate brokers like Marcus & Millichap, CB, and they're going to be looking to sell out of the equity position, to re-up with mezzanine equity financing, possibly refi, or just sell, walk away, maybe and do a short sale. So we're probably going to see short sales towards the latter end of this year before those tax rates go up. So GSE 60 plus days. I can't see that because I'm looking at my face there. So Fannie and Freddie, there is a difference between the two. Freddie didn't do SB or didn't originate SBL debt, primarily stuff under 7 million until I want to say about 2014, 2015 is when they came out with their SBL product. Fannie was mostly on the SBL side. So that's some of the key differentiators between the two. Fannie also does a lot of the low income or LIHTC and Section 8 financings, as well as the FHA 40-year financing. So if you look at the two tranches, I would say Fannie has generally that higher risk, more of that middle market nature to it, as well as the fixed income or low income, as well as FHA. And then Freddie Mac is the larger, more institutional quality multifamily assets, typically class B plus and up in a lot of core locations, but also some tertiary markets. So obviously you can see Fannie had a bit more of a spike, right? Since the Freddie crowd probably gets to put their headphones on and work from home on Zoom and things, and then Fannie Mae, those are probably mostly your blue collar tenants who didn't get to go to work, or a lesser degree could work from home, or were defined as essential. So plus this is also 60 plus days, so it looks like a big jump. It's only 1%, right? So not to scare anybody, that's still a lot considering they have the largest share of multifamily housing loans. Just to give you sort of a prequel, right? During the downturn, again, it took a little bit quicker for the downturn to hit in the multifamily category, obviously, because we had a housing and a consumer crisis before we had the commercial crisis, which this time I think it will be switched, right? Commercial will hit first since we closed people's businesses, et cetera. Change in office demand, hospitality demand, et cetera. But back then, they peaked out at 0.8% default, which is really, really strong. We already went beyond those initial default or 60 plus days late for Fannie. So, and I don't think the needle's done jumping yet. So that would be my biggest takeaway from this. I don't think the needle's done jumping yet, and it's not really we're not seeing the extent of this yet, this current cycle. So where are we in the debt process, right? Because okay, cool, we're between we're hyper supply of credit and now starting to come back, right? That tide's starting to roll back. This is sort of I guess you could say the cycle within the cycle. This is the process that dictates a very large cycle, right? Commercial real estate, multifamily loans, one of the largest asset classes in the United States, in the world. Banks hold the majority of them, which if you've been through the origination process, you probably know banks take a long time to do a lot of things, specifically selling out the loans and getting it all the way. So it starts off from a performing loan. Like I said, 1 to 2% is your standard default rates. During recessions or the cycle change, you'll spike 2 to 5% overall, and then hitting spikes as high as 10. Maybe it goes higher this time. I don't know. I don't know. Not here to be a chicken little or sell everybody a huge, distressed debt opportunity, but I do think it's coming. 90 days plus past due. This is where the majority of assets are right now, and what's called the shadow inventory, right? It's not really, you haven't started the foreclosure process or served with notice of default, notice of foreclosure, because we've had the moratorium through the end of June. CDC is still pushing for it. Obviously media is still pushing for it, and some jurisdictions are. And then that's on top of the entire backlog of just your standard 1 to 2%. So if we withheld that for a year, you would assume that now we're somewhere just random numbers at 4% to clear that initial inventory. And then you have the remnants of the COVID lockdowns and the more permanent shifts in demand as well, right? Things like retail and hotel, like we said. But right now, almost all of them are stuck right before foreclosure, and I think it's a pretty swelling inventory. Litigation foreclosure, that's going to be the really, really interesting part. That's kind of the next leg, right? When do the moratoriums get lifted? Do they get reinstated? Do local jurisdictions say, hey, they'll just pay no mind to CDC and the Fed, or the state come in? What happens? And then who keeps writing checks for folks to pay rent or keeping their businesses afloat? We got to get to the end of that before we get into foreclosure, because no one really wants to willfully go into foreclosure. And then post foreclosure is what most folks are used to when it comes to distressed debt opportunities, which is why as a loan sale advisor, your goal is to get there before foreclosure, because that's when the rest of the market is back on it. That's when the servicer, the receiver might take over, and the people who basically specially service the asset, right? So a lot of the realtors will go, and if your realtors or brokers listening, you want to go to the special servicers to help them special service and serve as receiver, and give them the information of how much it's worth, how much you can rent it for, or give them the management, in hopes that they come to you for sale as a REO. If you want to get ahead of that, ahead of your competition, then also start getting mindful and just building up your knowledge of loan sale advisory to kind of preempt that supply, right? The early bird getting the worm, so to speak. So I hope that's not rambling too much, but I really want to help these guys and build up what we went over last year. And now I want to make sure I'm focusing on these questions here in the chat. So that's kind of where we are. So the stretch supply is coming. I don't know how big it's going to be. I think it's going to be at least double what it typically is. So I think we're immediately going to see that 2 to 5% starting at the I would say fourth quarter this year. We're going to start seeing it trickle in after the third quarter, right? Because I would say July is kind of 0 hour for things to open back up and for the distressed asset process to work itself through, right? Through 30 to 89 days past due, 90 days past due, and then in foreclosure, and then post foreclosure, and then hit the market as distress fee simple. So you want to get there before that. So in order to do that, you've got to source these CRE non-performing loan opportunities, right? So the core process is or I could say the core fundamentals of sourcing a loan sale advisor or distressed CRE Mpls opportunities is it's on people. It's still on people, just like brokerage, just like most businesses. It's much heavier in terms of processes, as well as kind of being in tune with the market and the participants, right? We just went over, hey, it's the banks, CMBS, hotels, and retail right now, right? And those are kind of who to focus on, and look at to the borrowers in the equity position to sell out via short sale, discounted payoff, etc. So that's some really good advice for you right now. I look at this market; it's really tough. It's very process heavy, and there's a lot of nuances. So we're going to try to break that down into smaller, digestible pieces that everybody can kind of relate to. I am a real big believer of threes and having two sides of the equation here. So if you see here, I could have probably reversed this, but I wanted to start off a bit more relative and specific to loan sales than like the broader sense of it. So, but these are basically, they could match. You could draw a line to each of these dots, right? So you got to triangulate three things in order to make a loan sale happen. You got to get your lead, which is typically going to be your asset manager, your executive, your decision maker, right? You got to get your account, right? Who is the lender or the broker? Who are you getting this or who does this lead work for, right? Who do they represent? And then you got to find the opportunity, right? What exactly are we selling? So I like to start, and there's two kind of train of thoughts. You can start either broad or specific, right? Like if you want to go to a networking event and you want to focus on, we're actually going to the IMN, we're sponsoring the IMN event next Wednesday, I think, down in Dana Point, California. It's supposed to be a really nice conference. Those where a lot of the institutional clients are and a lot of the investors as well. Our focus is to try to meet those leads that we know are the decision makers and sort of just, maintain, nurture, and grow our relationships there. But so lead, account, opportunity, right? The lead is the asset manager or the executive for the firm, the lender, right? What type of lender, what kind of loan as well, and then, or I should say more, what kind of loan, and then what kind of property type. So we can start, and I'll just go over each of these really quickly, just a little bit more description, and then kind of tell you how they interact. Like I said, if you guys have questions, feel free to stop. So asset manager and executives, focus on finding the primary decision maker, do your research, or utilize high touch outreach. What this means is try to find out who is likely to be the decision maker on, who determines when to sell the note, how much to sell it for, and if a sale can be consummated or if they use a broker, right? I tend to focus on, or the lead, I tend to focus on finding people on LinkedIn, as well as, networking conferences, etc. But the key positions you want to focus on is special assets, asset manager, and there's about a million variations of that. You could be troubled asset work or loan workouts, but the department in the financial institutions, typically banks, where they're going to be dealing with distressed assets, right? Once the loan goes bad or they stop paying, right? So special servicing, I just call it special assets or special assets group, special assets management. Asset manager is another good one. SVP, you typically want to look for people who have authority to execute and bind the firm, the account, to agreements and the contracts. So SVPs and higher, CEO, CFO, chief credit officers are also good. They're usually going to be towards that front end of the NPL process, right? Once it goes bad, once it's that 30 days past due. And then your executives are usually going to make the decision, to sell or not sell, or to foreclose, what have you, right? Or to modify. President, vice president, assistant vice presidents and lower typically don't have that authority to bind, but it depends how the process is set up. Excuse me.
I was a vice president for Chase Bank one day. Didn't mean I could do shit for him. Because every bank manager is a vice president of banking. So I love what you just said in outlining the specific job titles and reaching out to it. So yeah, great stuff. The SVP, definitely well worth it. So
Yeah, thank you. And hey, even though you are nobody to the big banks, you're somebody on this note camp. You're somebody to me and in this business. You got to be special to be in this business, and you got to definitely be patient and have thick skin, and you got to pay attention to details. And then, if I could trade it all for being lucky, I would. So you work hard to get lucky. You make your own luck. So these are all the little tips I found along the way.
Mike, let me ask you a question. You mentioned LinkedIn, and I love LinkedIn. I use Octopus CRM over there to do a lot of stuff there for you. If you had to think about it, how many contacts, what's the average number of time you've probably touched base with a contact before they sent you something or entertained selling a note to you? Because I think we all know most people give up after like one phone call, one email, one contact. It's not that follow-up. And I think you got to follow up religiously, right?
Yeah. And that's a really good point. And thank you for the octopus.io. That literally sent me down this whole other rabbit hole of software for social media that I've been on like the last year. If Dre's listening, he's the one that has to square away all the invoices for all the stuff I try, for all the software, because we're constantly looking to leverage our labor. So if you're an LSA, or like let's say you're a big CBRE broker, right? You sell triple nets, but Does your being a loan sale advisor part-time or on nights and weekends or whatever, does that affect your non-compete or your fiduciary there? So that's one thing I think a lot of people can take advantage of, especially this work from home revolution. Um, um, in terms of software, I like, oh shoot, sorry. Oh, great. I don't know how to go back on it. There you go. In terms of software, I've been using, what's it called? I use outreach.io with my Gmail, my G
Yeah.
Suite, Outlook, and they just most of the bankers are using Outlook, but getting past their filtration systems, their
Yeah.
number one threat is, and you can probably attest to this, is phishing and spamming. Spamming wastes a ton of their time, and usually introduces the security breach. And then spamming or phishing is when they click on that link or upload. I want to share something with Google from Google Drive with you. So that's their number one threat, and they've been Outlook's obviously been compromised on it if you've been paying attention to the headlines. But we use what is it? It's called I'll have to get back to you on the LinkedIn service that we use, but it's great. It's great. I use LinkedIn a lot. I've got about 12,000 connections. The typical sales cycle for getting a loan in-house, and getting a shot at it, right? To quote, hey, like in the brokerage world to give your BOV, you're usually talking at least 90 days.
Yeah.
There's a lot of different processes, banks especially. It's really tough, but making sure you lead with good questions and, like I call it, high touch outreach, because I did a lot of the low touch outreach where you're just sending out mass email campaigns,
Right.
thinking like typically a broker, like, oh, I want to show my listing to everybody, or I'm an originator, I want to show my rate sheets and term sheets and tombstones to everybody. Well, the bankers are a little bit busy for that, and they're
Yeah.
also in the business of origination. They're not in the business of selling loans, and they're mostly in the business of providing capital and credit to their community. So it's a big decision for them typically to sell these notes, and there's different tiers of bankers. The larger ones typically have dedicated departments and staff to it, who are a lot less, I could say, emotional, or have a lot less ties to their assets, their non-performing loans. They're much more business and credit oriented. The mid-tier banks, that's when it really becomes, I think, a struggle for some of them. Some of them get it and are ready to grow or have their own division or can handle it with just a few staff, and they're very pro loan sale. Some of them want to work it out. It all depends usually what their growth strategy is. That's what I've come to find,
Right.
because a lot of those mid-tier banks, some of them are in hot hands. I talked to one that had 5 acquisitions of banks in the last 5 years.
Yeah.
Some of them
A
are
lot of
using
legacy assets sitting on their books, isn't it?
Yeah, and some of them are facing competition from the larger regionals, in their, stepping on their turf, and expanding into those more traditionally tertiary markets. So they're fighting back by shedding the balance sheet, the stuff and the credits they don't want to pay, and reinvesting in technology.
Mhm.
Um, so it's really important to kind of know that, and that's what I mean by high touch. Sorry to diverge on such a track, but
Well,
it's really
good
important.
stuff, man. Good stuff. I think the one big thing too, I see people screw up when they use their emails, info or contact us at.
Mhm.
And that's the keywords that a spam filtered a bank will filter through right off the bat.
Yeah, so that's the main thing. I believe it's called DKIM. So there's a couple different addresses when you send. There's the actual sender. There's obviously the recipient, and then there's where the server or the host is, and the URL. So you want that URL, that server, and that sender to all match, because that says, hey, this is from one person to another, and they more than likely got their address from them directly. Because why else would they be typing? Why are they all aligned? So I think you got a really good shot at getting in the inbox. Still trying to think of that LinkedIn software. It's driving me crazy. It's the full screen mode. I can't see it because I usually have like a million windows up. But yeah, getting that server with an important high touch message. Because if you get in there, you don't want to say, hey, I sell notes. I could sell yours for more, right? It's usually better if you find that key contact and you introduce yourself properly and say, hey, I'm here to buy these kind of notes, or I'm here to help you sell these kind of notes, or I'm here to offer you whatever your value proposition. Give it to them directly. Ask them, if they're the main contact or the decision maker for that, specific thing. Not like, oh, I want to do everything. And you can't send them attachments and links. Attachments and links are major no-no. So it is like a true, like you're almost like you're writing them a letter. That's how I like to look at it. So anyway, I'll keep moving on. So and with that in mind, not all lenders are the same, right? Bankers are very busy. with regulatory burden and getting those reports out and going to committee and meetings and working things out with the borrowers that they want in their community, right? If they don't like them, then they're usually, it's a good way to talk to banks. Say, hey, are there any credits that you want off your books, right? Because they always have one. There's always some guy out there that's messing up. And that's obviously different than the GSEs, right? Fannie and Freddie, a lot more, I guess you could say bureaucratic, kind of different kind. And then CMBS guys, you're talking specifically to special servicers, hard to get a hold of. But they're much more direct, like, yeah, no, we're not selling, or I'll sell this on my own, thanks, right? That's usually what you hear from them. The account, this is really important, knowing your account, because like Scott suggested, it take the sales cycle for LSA, it's about the same as your typical commercial real estate sales cycle, except it takes a little bit longer to get that first opportunity in-house. And what I mean, I was a broker for a while. I was at Trammell Crow Company, and I was a mortgage banker for a while for Grandbridge Real Estate Capital, doing a lot of agency and CMBS. I was a life co-lender as well. Getting that intro, getting them in, getting the lender to actually open up and talk to you, that is the hardest part, especially when you're talking about Mpls, because it's somebody's mistake. And there's a lot of politics that come into play, and a lot of red tape, from all around. So for them to let you in and talk to you about that, you can't just shoot them a pitchy, salesy email with your flyer that's all about you. You've got to focus in on that opportunity, that leader's role, and what their motivation is, and what their goals and objectives are, and how your value proposition helps them with that. So I say give them 90 days typically, between initial high touch outreach and continued follow-ups, 90 days just to get an answer. So and longer. But I think it's worth it. The fees are a bit higher than originations, et cetera. But one of the key things that helps you with that is learn the account and map it out. Hey, this is their secretary. This is their special assets senior vice president. He rolls up under him. This is who I'm calling. This is his role on his team, and this is what he does all day. So, and he can help you build report stuff. So learn your account and kind of how the processes work, right? Hey, do you guys sell?
Definitely learning like the loan sale, how often the committee meet too, a lot of times, right?
Yeah. Hey, do you guys sell yourself? Do you hire a receiver? If you can get that, you usually get 3, maybe 5 good questions you can ask if you catch them, or they respond to an email. If you can just ask them one question, be like, hey, are you the guy to talk to about loan sales? And how often do you guys sell? Or when should I follow up again? Simple as that. Just be very mindful of their time, speak very efficiently, and be very clear about what your value proposition is. So CRE, focus your attention on the assets, markets, property types you're familiar with. If you are a residential land broker, or agricultural land broker, call banks with agricultural land. Look for that on the balance sheet. If you're a receiver for single family rental portfolios and small multifamily like mom and pops, go focus on your community banking relationships. Maybe don't go after the CMBS guys so much. So focus on what you guys know. We sell everything. If it's commercial real estate, I'm going to sell it, especially if it's paper. Sorry, mostly if it's paper. Sorry, I don't like selling REO as much, but I will. So focus on the things that you know best and try to branch out from there, because you're going to be tacking on this whole the fact that you're selling the note versus the actual fee simple. So you're already going outside of the box and you're pushing your boundaries within your comfort zones, and you're typically shuffling around and totally reorganizing some of your marketing, some of your underwriting, as well as your networks. Right, you're going to need different people to achieve different goals. So just keep that all in mind, and so try to focus on the property types and I would say asset status, whether it's performing, subperforming, non-performing. So try to be more focused, and express that simply to the lender when you do get their attention. So that'll make your life a lot easier. Opportunity. So this is the hardest part to find. You can get the right guy at the right lender. Yeah, I'm the head of special asset sales, troubled asset workouts, and I'm the head of loan sales, right? What do you want to talk about? Because I'm busy, right? So if you have an opportunity in mind, that's always really good, because you don't want to try to force it out of them. So sometimes you want to start with the opportunity, specifically with CMBS, I would go find, whatever is in your backyard. Hey, you're familiar with hotels in your region, and you got an equity sponsor that has a management arm to it, and you're comfortable with the risk, right? You got a lawyer or two on your team or whatever. Find that opportunity and then track down the lender and then track down the lead. So I like to start with one of these three, like fill the who's my lead account opportunity. You're going to be dealing with a variable or an unknown, like how do I get a hold of that lead? Who is the decision maker on this specific loan? It's very hard to triangulate all three. The opportunity is kind of the key because you can always get there directly or get there via the lead or the account, but that is the hardest part, to get them to share with you the details of that opportunity. And there's no public record for it, right? It's not like you're calling for a loan sale or an investment sale listing where you can, look through the chain of title, look through the division of corporations and call the guy. Say, hey Bob, yeah, I want to sell your retail building. I want to sell your warehouse. That's what I used to do. I think I can sell for $85 a foot. Let me come by and shake your hand and, and walk the property and make you look cool in front of your tenants like the boss. And then I'll go throw a BOV out there in a listing, right? So it's a little bit different, but still kind of rhymes. So I hope that was enough. I know it's getting a little long-winded. So now let's focus on once you source them, right, for the buy side, which is probably a little bit easier to do because it's a bit more focused. Distressed CRE Mpls and REO acquisitions they're not the same as your fee simple market transactions. The culture and the tactics and strategy is a bit different. So these are some of the fundamentals I think that causes it, and sort of people's motivations and just to help you kind of understand. So this is just kind of the fundamentals here. Most importantly, you're not buying fee simple title, right? You're buying the lien or the claimed title. So therefore, the processes are going to have to change, as well as what you look for in opportunities, right? So, you may have been a CTL, a net tenant lease or credit tenant lease investor, right? So you want to go look for retail opportunities. Well, it's a bit different, right? Are you going to be able to stabilize it, or are you going to look to work it out with the borrower, or are you going to look to take it back and get in someone else, right? Like, kind of got to know your strategy and kind of understand how that affects title versus just grabbing the fee simple. There's a huge difference, and not a lot of people are aware of that. So just try to focus and be mindful of that. Well, coming along with that, now that you're dealing with the title and not the fee simple, there is a lot less liquidity. That's really the issue, and why these dislocations in these market in the market kind of the cycles exist, is because of inefficiencies in the whole liquidity flywheel, right? Very easy for lenders to lend or originate, very easy for borrowers to exchange their title or their claim to title for liquidity from the bank. Right, that's what banks are set up for, and that's what mortgages are made for. But then when the bank needs to get liquidity in exchange for its mortgage, where does it go? Right, if it's a QM mortgage, like a 30-year FHA mortgage, they just go to the secondary market. For CRE, it's a bit more nuanced. So that affects liquidity and obviously marketability and ultimately sale price. And our job as a LSA is to make sure we maximize the efficiency of the process, right? Why did the lender sell? That's really, really important to understand your seller's motivation. That's in leasing, sales, originations, et cetera, especially so for loan sale advisors. And it's tougher to get that out of the lender. That's why we want to do that a high touch to build that rapport, so they feel comfortable sharing information. That's why we want to do our research and reach out with very pointed, specific questions that show that we did our research and we really understand what their motivations are, right? Because then we convince them we can help them, and then maybe they give us a shot. So lenders like to sell, or typically will sell for headline risk, right? We just had a lender the other day, I won't say where, they had a real estate loan as well as C&I loans. So they had a bit of credit issued to a local, we'll say, industrial user, right? Both for real estate as well as C&I and operating. They got 40 jobs in town, they hire 40 people in town. They don't want to foreclose and be blamed in the media for forcing those jobs and that business to close. So that's a serious headline risk. I'm trying to grow my business to show the community I care about them. This guy's not paying me, but if I go and foreclose, it's a tough time for our community. It's going to scare the flock, right? And then I'm going to be the persona non grata in the evil corporation. So headline risk, I think, is a really, really big motivator this cycle for the reason why we're going to see an increase in loan sale activity. Credit relationship management, again, it's this one business. He didn't pay, he took out triple Ps. He's not paying me back, and he's having to, I don't know if Jim is going to make it. Jim and his plant are going to make it, right? So what do? I don't want to be the, sorry here. I don't want to be the guy that takes, oh no, I'm going the wrong way on the presentation. My worst nightmares here come true.
You're doing good. We can always flip
Gotta
around.
slow down. All right, so yeah, so headline risk, credit related, and I think there's going to be a lot more headline risk with the way the media is going. You guys interpret that as however you wish. I'm not going to get on a political diatribe. That's not my purpose here. Lender liability is another big one. You're talking about, hey, they're going to be less likely to take back a retail center with a dry cleaner, on-site dry cleaner on it, right? Because of environmental liability that sticks to chain of title. And then economics. Hey, I'm going to sell this loan because I don't want to get paid for bankruptcy court, or I don't want to wait for another year of moratorium or close downs. And I'm afraid I'm timing the market, right? Pure economics. Or the deal small enough to where they're like, hey, I'm not going to go pay 20K to foreclose this guy, or it's going to be another 30K to get through BK court or whatever. The economics don't make sense. I'll call it a loss. Those are the smart lenders who are typically not politically or emotionally motivated. And then the last thing for buying these CRE Mpls is focus on the right opportunities and building the right relationships. Like I said, if you're used to investing in fee simple or being an intermediary in fee simple on the origination side or sales or leasing side, know that this is a bit different. So you're not going to be able to just rely on your same strategies, tactics, or network or way of doing things. You're going to have to change. You're going to have to adapt. So if you're here, your head's in the right place. You're doing a lot. I think this will be hopefully this presentation will be very valuable to you guys. Okay, so here's what the acquisition process looks like for NPLs. It's probably not a surprise, right? You're going to source and qualify assets, or opportunities. You're going to underwrite them. You're going to put together an offer, and then hopefully, without as much or as little negotiation as you wish, just the right amount, you'll go to closing and you'll close. It's pretty comprehensive, pretty self-explanatory. So what I wanted to do is focus on sort of the differences. You're going to spend a lot more time sourcing and qualifying these opportunities because it's just a bit more nuanced. You got to like the asset, the location, but then you also have to understand what's going on with your path to title and what the strategies are to get out, right? You don't just get to buy the property from the owner and he throws you the keys and says, hey, have at it, and then he opens the doors and all the factory and retail workers are happy you're the new owner, right? It's a lot different. You're walking into hostile environments. Hey, do I want to be a white knight investor or do I want to be a black knight investor? Do I want to work it out or do I want this guy out of here, right? So you got to match all that up during the underwriting process. Here's the number one thing when I think why I have a job. It takes a lot of due diligence to underwrite these accurately. Pricing discovery is my number one value proposition, and we achieve that by organizing all of the details up front to make sure we maximize speed, efficiency, and certainty of execution for our proposed loan sale transactions. Right, that's my value. So in order to do that, the buyer has to underwrite it as well. I hate to say this, as well as the seller, right? Because they have their own methodology of evaluating and doing the credit or risk analysis for regulations. The appraisal. You can't just rely on an appraisal for an MPL deal, right? Because obviously you're not dealing with fee simple, you're dealing with the title. So underwriting is everything, and having all the due diligence and knowing what to look for is key to that. Once you get the deal, you'll be able to give it a quick look through on the basic underwriting. When you get good and you get the reps in, then you're going to know what to ask for before you send that offer in. That is the key. If you're going to discount this, for lenders out there as well as brokers and buyers, every unknown that you have that can't be answered in the due diligence, right? You're going to discount to the downside. Well, hey, he hasn't filed BK yet, so I'm going to assume there's at least a 50-50 chance that he does, right? So I'm going to price that into my offer, because once you get his lender and you close, you're not getting your money back. So that's the other part why you got to have a really good offer. I would recommend finding and qualifying your deal up front. especially expectations, get as much information as you can, underwrite as much information as you can, ask for the right stuff if you can, if you're able to. Put your offer based on that, give a good, solid, comprehensive LOI or indicative offer. Say, hey, this is where I'm at based on the information you provided. Here's the questions I have that could potentially increase my value, or here's the things that could potentially decrease. If anything, you want to be a bit more conservative. Again, you're not pitching to owners of assets or borrowers or tenants. You're pitching to lenders. If they're interested in selling the loan, there's going to be two reasons for that. So figure out their motivation. They really want to get rid of it, or they're just interested in knowing what the price is, if they could get out of it. So maybe they're on the fence deciding. You want your offer to make sure that it closes, because you don't want to tell them, hey, I'll give you 95 cents on the dollar, and then the actual due diligence period comes in and then you're at 60 cents, and then you just waste everybody's time. So get it all up front so you can put together an offer that you can close on. So I recommend source to qualify, underwrite, put the LOI, indicative offer, and then any questions you have that weren't answered in that initial due diligence underwriting period, and then put together your best and final. Hopefully it's very close to what you initially offered, and then close typically 10 days less. Do your due diligence up front so you can do 0 to 10 days DD, 0 to 10 days close. Any questions on that, Scott? I don't know if you had anything pop up in the chat here, and I want to make sure I'm going at a decent pace here for time.
I mean, I think that's also you realize too. Initially, I think making an offer, sometimes they don't say no. I think some of the best deals come from just falling back up, 60, 90 days, stuff didn't close. And especially
Yes.
if you know the deal, you've really done your due diligence, know the deal, and you're not going to bid above what you need to bid, falling back up often leads to some really good deals, because the more motivated or the longer it's in default or the closer to the end of the quarter, especially the end of the year, the banks have got to make some decisions, and you just got to follow up.
You are absolutely right. That's why I really like getting the due diligence. I think it all focuses around the due diligence, right? How am I going to make an accurate offer or evaluation of the property and the underlying risk if I don't have the due diligence to do it? And then you can't always gain access to the actual physical collateral as well. That's pretty rare. So following up, and like I said, a lot of times that's what I use as a key indicator of how serious and motivated the seller is to actually liquidate or dispose of the asset. If they don't have the due diligence and they're not getting it to you, they're not very motivated, or their focus is elsewhere. So that's like you said, if you ask for the due diligence because you went and tell them, hey, I want to put together an offer. I saw it looks like I could be somewhere from 80 to 90 cents on the dollar just based on the information I have. Getting these items to me would really help me sharpen my pencil. Would you be interested in that? Right? No, cool. When should I follow up? No, we're just gonna go foreclose 90. We want par. Cool. If it's par, you may just want to walk on most of these things.
Amen
But
to
anyway.
that. This par is non-performing. So I've even sent an email said, hey, can you pass the crack pipe? Because if you're getting par on a non-performing, kudos to you. It must be some good shit.
Okay. Okay, so you're gonna like what I had to say at the end of this, because we're actually seeing an instance, because where we are in the market, just with the liquidity, where we're selling NPLs at premium, and I'm gonna tell you guys how to find those specific opportunities, or at least how to qualify them, because it's not crazy. It's not crazy. It sounds crazy. Trust me, I feel crazy saying NPLs at a premium to par, but it's a bit more nuanced than that. But that'll be towards the end here. So lastly, wrapping up buying CRE NPLs. These are the must-haves. If you don't have these, either you are going to what's called retrade, right? Your best and final offer, the one you put on the purchase sale agreement, is going to be different than that initial offer. So these are the things to make sure you get there. I would say number one, that kind of one of the real key aspects, like I said, due diligence in this whole process, underwriting process, of determining how serious they are as sellers. Ask them if they have a draft purchase and sale agreement. Hey, because we're here to sign a purchase and sale agreement. Yeah. Do you guys have a draft purchase and sale agreement? Okay, cool. What's your process for approving that? Can I share mine? Or just, hey, start off. I usually start off with just sending confidentiality. That's not required. Sometimes they'll send yours, but you got to have these little checkpoints, these give and takes to determine, hey, cool, he's not ready. I'll follow up in 30, 60, 90. That's my process, right?
Yep.
And then how many times do I follow up before I usually keep following up till they tell me to go pound sand. So that's me though. Full due diligence. You're going to do the full due diligence at some point. The question is when. So I prefer to do it before you submit your initial any kind of written offer, whether that's an indicative written offer or a straight best and final. We do go straight best and final sometimes. Sometimes we'll only market assets for 2 weeks confidentially. I'll know who to match it up with, or on my business partner Andre will know who to match it up with. And we market it for 2 weeks. We get 5 offers, and they're ready to go. So they do all that due diligence up front. So if you do it after you offer, then your offer is likely to get retraded and not close. And then you're wasting all that marketing momentum, all that, like you said, that if they're not ready, they just follow up. A lot of those guys, you're going to lose them if they're on the hook to either buy or sell, if you don't have all your stuff in a row, or if your deal falls out. Like Scott said, half the time you guys find loans is because someone else fell out. I can't express that enough. And this is why, because they didn't do their due diligence. And now that lender is going to have that number that was, it's a mirage. It's fake. It's a fugazi, right? If you're familiar with that term. I'm from South Jersey, Philadelphia area. So you got to get them over that number, right? So try to get that when you're trying to qualify your deal. Non-refundable hard deposits. Hey, if you're a buyer and you submit an LOI with a non-refundable hard deposit in a quick closing time, said, hey, I did all my due diligence based on what you provided me. Here are the few items I'm missing. I'm almost positive I can close at 85 cents on the dollar, maybe a little higher. I'm willing to put my hard deposit on it to get rid of all those phonies that say they're going to pay you part of 95 cents. And they're going to waste your time for the next 90 days. So that speaks volumes. Having hard deposit, also having proof of funds. I'll skip ahead a little bit. Proof of funds to say, hey, I've got all the cash to close and more. I'm willing to put a hard deposit. I did my research. Here are the items you need to show me before I enter in a purchase and sale agreement. By the way, here's my draft PSA, right? They want out of the deal. It's another thing. Does the borrower or does the lender really want out of the deal? If they want out, they're not looking for participation or to keep servicing. That's what I like to hear too. Also, you want them to be out of the deal too, so you can go take over, hopefully get pat the title, or modify however you wish, whatever your strategy is. Limit the reps and warrants. They're not going to rep and warrant much. That just adds to the lender liability that's hanging out there for always and forever. So they're basically just going to say, hey, we're the lender. We made this guy a loan in this amount. Here's the UPB. Here's the full payoff that we believe we're owed. We're not going to rep and warrant that amount. Why would I? What if the judge strikes down my default interest, right? So typically they're going to rep and warrant the UPB. So that's going to be par. So I say you can sell an NPL above par. They're going to rep and warrant that UPB, right? This is the amount he owed us on this date. And we are the lender as of this date. That's pretty much all you're going to get. Make sure you get free and clear, or insurable updated title. So contact with decision makers. Lenders, one thing you're going to learn about them is they operate or lead via committee. You are typically not going to speak to everybody that's in the room who's going to vote on selling that asset. Anyone typically over $1 billion in assets under management, it's typically more than one guy making the calls, right? I mean, Scott, you tell me how many guys are sitting on $1 billion and making all the calls by themselves? Not many, right? They're going to the moon, right? Richard Branson.
It's like it's like Gordon Gekko with his team of advisors sitting around a table there for the most part. Or the Richard Gere's character in Pretty Woman, where he's got a team around there deciding how they're gonna do that asset.
Yeah. I love in terms of real estate, I like, I'm a Gen Xer, I'm a young Xer, or maybe just an old millennial because the haircut, right? I like Glenn Ross. I like Boiler Room was really good too.
Oh yeah.
It had the great hip hop soundtrack from the 90s, early 2000s. But Big Short, I would probably say is a really, really good one if you guys really want to learn more about just how the capital markets react, and are slow to act or slow to shift. It's really interesting. I think it's kind of the life I'm in, almost the Big Short 2.0. So it's a little bit different this time around. But make sure you have contact with decision makers. There's 2 ways to do that, right? You contact them. Hey, are you a decision maker? That guy that you talk to is typically going to be the hands-on asset manager. So we got a comment here. Big Short is awesome. Yeah, Big Short is awesome. Way to go. Michael Burry's been saying some really interesting stuff. Sorry, I stopped for that. Just want to make sure I stay on top of the comments. Make sure you have contact and know what the limit is to the decision maker. So you might be working with the SVP, asset manager, who is charged with this loan sale, right? He's making the decision makes or the key decisions on the daily stuff. Like, okay, cool, yeah, we're gonna sell this. That he may still need to get approval. He will almost certainly have to get approval to take a loss. Banks aren't going to typically take a loss with just one guy writing it. They need signatures for other people. So you got to communicate very clearly, efficiently, and effective with that contact, with that lead, but then also ask them learn more about their decision-making process. The best way to do that is to get a if you're buying, you want to get that LOI and get it countersigned. Okay, and then enter officially and then put your deposit up, and then do your last remaining due diligence if there's any items, but get that purchase sale agreement with that non-refundable deposit and wiring funds. Till then, it's not done. Banks, once they agree the price, though, they're usually pretty good to go. If you're not making, you're not going to basically get to directly pitch all of those decision makers. So put an awesome LOI together in writing. That is the best way to make your communication, your value proposition to those guys that you don't get to speak directly with. That's what they're going to read during their committee to whether accept or approve your bid and to move forward. So I advise you to put your LOIs in writing always. And then secondly, attach your proof of funds with them. Right, here's my LOI. I have proof of funds that you've verified, and this is my strategy, or this is my resume, and this is what I own in town. Right, so these are all the things you can do to make sure that it's not always the highest bid or the fastest close. Certainty of execution is probably the most important thing next to price. So okay, loan sale fundamentals. Again, I've got my screen here in the way.
Good stuff, Mike. This is good stuff.
Yeah, it built up. Yeah, last time it's really tough to consolidate all this information, but since we had a decent base to start with, like, hey, this is what a non-performing loan is, because you never know who you're talking to, and plus, the market wasn't the cycle wasn't as fully baked as it is now. It's like basically, I think it's teetering on the edge. So it's pretty crazy, man. But here are some of the key loan sale fundamentals. And I'm looking. You can kind of look at this a little bit from the buy side, right? Like trying to understand why the participants, what sort of motivates them to sell. What are some of the core nuances and things like that, right? We've touched on some of these to a certain extent, but this is really why it's important for the sellers, right? And what they're looking at and what they're dealing with, right? So the primary issue and why we have jobs here, and why they want to do the loan sales or are motivated to, is the core function of lenders is to originate and service debt or the credit that they issue, right? They're not in the business of sale and marketing of non-performing loans, right? So 1 to 2% is a healthy lender, and then 2% to 10%, right? Well, that 2 to 10%, how did they get there? Right? Why did they handle everything at 2%, right? Once it spiked up, because they're not made to do that. And there's a process, there's a committee, and they want to make sure they go through all their checks and balances. There's a lot of red tape. So, but that's kind of why we have these cycles to a certain extent, why they're prolonged, why there's interventions and all this stuff. They're not made, it's like a big ship. Like how fast can a cruise ship go, go backwards, right? Not fast at all. So lenders are kind of the same way. And it takes a lot for them to adjust. They're also not in the business of owning and managing real estate. Okay. They don't want to be on title, right? If they wanted to own the real estate, they would invest, they'll invest equity in mezz and they'll foreclose like that, right? Loan to own. They're in the business of originating the debt, charging origination fees, charging servicing fees to watch or service the debt. And then when it goes bad, trying to get it back to performing or working it out to its conclusion where, yes, they may end up taking title. So you've got to really understand and clearly communicate the opportunity cost of ownership. Not all lenders understand that, okay? A lot of these lenders go into foreclosure or into the deal thinking there's so much equity. Look at this appraisal. I'm chasing, to grow the account with Jim and his factory in downtown, you know, making masks. You know, I don't know how long that market holds out. Um, so you know, they have a lot of different motivations to get into the deals, right? And there's regulations to do it, and there's quite a bit more on getting out. So it's much harder for them to drive and reverse and get out of the deal. So you have to understand, and you really have to, like I said, communicate the opportunity cost of them owning. Hey, Jim, the lender, do you really want to be on title? Hey, are you sure about, you know, the environmental concerns? Do you want to be seen in the media as foreclosing on these local businesses? Right? Hey, are you going to sell cash only? Or are you going to offer finance and tell in the deal, stay in the deal? So these are all very important things. That's one thing I look for probably the most is if you're talking to and trying to qualify the opportunity or the likelihood of selling at a reasonable price as a buyer or a seller, or you're talking to people on your committee, right? So what do you guys plan on doing after you take it back? And just wait to hear their answer. Most of them don't have good plans after that. Sorry.
Most of them don't have a clue.
I don't want to say that. I'll tell you what. You know, I was a life co-lender for a while. We knew exactly what we wanted to do.
Right.
We were very secure in our position, and you know, like I said, I don't know if I mentioned this in the last one. I was tasked with kind of being the makeshift special servicer for the Detroit office and industrial and hotel portfolio that we had. Hey, I don't want to foreclose on you. When can you pay me? Not at all. Okay. I think I'm going to go do a note sale. Would you be willing to offer deed in lieu? Yeah. Cool. I'll let you off the hook and off your full recourse guarantee. I'm going to sell it to somebody else. You can work it out with him. Right. So that segues perfectly in this last this segment here. Be very upfront with your expectations. If you're a lender or if you're working with a lender or the broker, be very upfront with the expectations. Hey, I want to buy, I want to pay this. This is what I look for. Here's my typical strategy or way home. What are you guys looking to sell? Does that move the needle, or should I just stop right here? Because there's a whole lot of opportunities to qualify and leads, etc. Okay, this is Andre speaking to the attendees. Okay, cool. Bigger the bank, the longer time. That can be the case sometimes. I just heard my phone go off. I have no idea where it is. Sorry. So here's to selling CRE Npls. Sorry, this is a little out of focus. This is part of what we actually present to lenders to help them walk them through our process. Our process. I recommend this for everybody. This should be sort of what you gear towards. It's not the same as selling fee simple, right? Or selling your services for fee simple. They want certainty of execution, price discovery, and that you know what you're doing. It's an organized process because, like I said, they're not the experts at getting out of the debt. You are as a loan sale advisor or even as the investor, right? So know what your your time frame is and your timeline, and what are the core processes and I guess you say check marks for that timeline to close, right? So here, right, doc collection. That's basically my job, getting lenders to come onto the site, right? That's why I'm the CXO. So they don't know I'm the head of sales, right? I don't know if anybody picked up on that. You got to get your foot in the door, and you got to get them to share those documents with you so you can wrap your head around the deal and figure out who's going to buy it, what are they going to pay, what's the value here. Because without that, you don't really have a deal, and then you're doing the standard broker shuffle where you're going to bid high, see where go out to the market and see where the offer's coming. I don't want to be the monkey in the middle. I built a platform, right, built for volume, and I can only do that if I'm efficient in what I do. And getting that, and if they don't give you the documents, they're not serious. To be quite honest, they're not organized, and they're not serious about selling, and they're not focused. So I would say follow up with them 30, 90 days later. Some of these guys will be I can say managing or servicing, but really they're mismanaging, misservicing. They're going to be mismanaging some of this stuff for years. There's still stuff from the 06 and 08 vintage that are still in special servicing or in some stage of zombie foreclosure. So indexing. A lot of times their due diligence files are a mess. You want to properly index and organize those so you can refer to those. Hey, Jim, I want to give you 95 cents on the dollar. Here's why I can't pay par. Look at your rent roll here, bud. Look at this rollover. This guy expired last year. What's the deal with that tenant? Do you know? Right? I want to get you an offer. I want to push it higher, but you got to give me this information. Can you get it for me? Cool. When can I follow back up if I don't hear from you, right? Then you call for offers. So if you're a broker or you're selling your NPL, right? It's the same. You want to have if you're leaving it out there for 90 days, especially in this market, there's a record amount of liquidity and demand for special assets. You should not have problem selling this. We typically market it for 4 weeks. If it's a really tough one, or it's really small, or the guy doesn't have all of the lender doesn't have his stuff together, or you don't have your stuff together, give it a little bit of a longer time frame to let those offers come in. And then it's a bit of a call and response when you're dealing with the market participants, right? The buyers and the lenders. When they come in with questions on due diligence and docs and indexing and things like that, try to have answers or get them the stuff they need to make their decisions. Otherwise, when in doubt, they will discount. So I like to do the indicative call for offers, typically 2 to 4 weeks, and then anywhere from 1 to 4 weeks for best and final. Hey, I got 5 buyers in here sending me offers. Here's the top 3, and I'm going to go back to feedback. Hey, 2 buyers, this is why you're out, right? You never close on a loan sale, and you never managed a hotel before, and you don't have full proof of funds. So your bid has been rejected. So sorry, right? Better luck next time. If you want to come back correct for the best and final and submit a bid, great, but you're not being invited. So the 3 guys, hey guys, here's where pricing shook out. We're getting you the information that you wanted. We'll get that to you shortly. Please, assume you're going to get that or get the proper answers. Please sharpen your pens for best and final, and make sure you look through your purchase and sale agreement. Tell us how much you want to deposit and what your closing time frame is going to look like. So you can kind of give them some feedback. They want the pricing and closing feedback more than anything. Hey, I've got 3 bidders all proofed up. One guy's a developer, one guy's a hotel owner, the other guy's a hotel lender that wants to convert it to multifamily, right? You are the top. You're in the lead by about 5 cents on the dollar. We're closing the gap, the bid-ask gap from what the lender wants. He wants 90 cents. You're at 85. Let's see if we can get there. Let me know what you need. And then closing, surety of execution, certainty of closing is of the utmost importance. When it takes a lot for these lenders to move and go through the process to sell their loan. If you get stood up at the closing table, something went wrong, and it's only going to reflect on you. And if you're a lender and you get something wrong or you can't get doc shipped, again, if you're a loan sale advisor, it always reflects on you. Lenders are slow to ship docs. Sometimes they'll have them in vaults. We had a story where we sold one. The docs, the hard docs, the wet ink signatures, hand signatures, they were in a data vault that was under lockdown because it got flooded due to hurricanes. So it took even longer for the docs to get shipped out. So that's why I really recommend doing the due diligence up front, so you don't have to ship back docs. People wanting to manually inspect, I know on Carson for NPNs, it's a bit more standard for them to ship docs to third party or intermediary or closing or escrow agent and inspect them. On commercial real estate, that is not the norm. So if you go out there and try to close on CRE Mpls, these lenders, if you ask them to ship docs somewhere, prior to close, they ship docs at closing. So just to let you know. So make sure you get updated title.
Yeah, that's the biggest thing. Bailey letter, you won't really get.
Bailey letter. Yeah.
It's all going to be scans, soft copies most of the time. Even on the residential stuff, even in bulk, it's scan copies. I mean, sometimes now you're buying a big pool from the major 5 or 10. You may have to actually fly in somewhere to evaluate their documents at Wells Fargo. Like we had to do that one time. Buying the portfolio, we'd actually go to San Antonio and check in and check out the loan docs, review them for due diligence. So,
yeah, I didn't know what that what was it again? Graham Bailey
letter, yeah, Bailey letter.
yeah. We didn't understand. I never even had an ask or request of that from a buyer until, I mean, shoot, I can't even tell you how many transactions. It literally just happened for the first time about a year and a half ago.
Yeah.
When these bridge lenders, kind of got, a lot of them got shook, so they started moving and kind of, the bigger fish were eating the smaller ones, so to speak.
Right.
I'm sure you guys saw some of that initial lockdown, some of the liquidity. That's when a lot of these guys in the yield curve inverted, and they switched over to, hey, now I want to buy distressed instead of lending, assuming that's going to get worked out. I'm going to now assume the worst and that it won't get worked out, and I'll be there, waiting for the hatchlings to fall out of the nest, right? Just
right.
Some humor. So those are the main. You can do it in 6 weeks. You can do it in a little longer. but be upfront, be organized, and be confident in your ability to execute based on whatever timeline you have. That's our timeline on our platform. If there's any lenders out there or any brokers that want to sell on our platform, we've got all ears, and that's kind of what we recommend. So this is the other part, and this is why this is the lessons here that we're going over, or whatever you want to call it, the minutia here that I'm all covering. It's starting to click, and it should be meshing together here. Let's see, we got another one here. We also had a buyer lose 2 commercial deals last year to other bidders because they insisted on Bailey. I have a tough time saying that. Bailey letters, doc inspection, non-starter for commercial. I can barely even say it. You go tell the head of special assets at Wells Fargo, you need the Graham Bailey letter 4, the hotel, or a CMBS servicer. They're going to skip right over you and go to the next guy. It's much more common on NPLs and non-qualifying owner-occupied residential mortgages. So we strictly do commercial, non-owner occupied. If it's SFR, single family rental portfolios, 5 properties and plus. Won't touch anything owner occupied or consumer credit. So that's just more background on me on my platform. Maybe we'll get into that in a year or two, but and this is why, because this is our focus is CRE, as well as multifamily. Whether you categorize that in with CRE or not, like the banks, that's up to you. I categorize it all as one. Doing the due diligence, qualifying the opportunity, this sets you up for success. Because now if I get a good amount of due diligence, not only can I price it accurately, and hey, I can get you out 4 to 6 weeks. Yeah, I know I've got the buyer penciled the moment I find these deals. I really do, and just because we've been doing it long enough. So I'm going to go real quick through these. I won't read these all through, but I just want to hit on a few main points, mostly like who they are, where you can find them, the who, where, and the what do they want to purchase, right? Maybe even the whys, which is always really interesting. Main Street investors, they are playing a major role. They've been playing a major role ever since the online auctions and the wholesalers came. I used to work for 10x auction.com. That's what kind of got me on the whole tech thing and online marketplace stuff. Main Street investors are playing a much larger role in the loan sale process because now they're getting tapped in and getting exposure to the supply side. Supply side is the hardest part to finding the distressed in the loan sales before their foreclosures. Most of the times in the past, you go back to the RTC days, Resolution Trust Corporation, Jimmy Carter, Paul Volcker days. Your regular SFR investor who owned 5, rental properties in, what town are you in again? Scott, are you in Austin or San Antonio?
I'm in Austin.
You're in Austin. So, go back 20 years, right? You have 5, you're not getting into the Resolution Trust Corporation with your balance sheet of 5 SFR deals. But since auction.com and DebtX and First Financial Network, now they're getting involved in the process. I think it's great. And we are supporting it, and we are trying to grow it by having an open listing format. So you can see the listings, you can search for them, and you don't have to show proof of funds to see the listings and start, kind of getting an idea of how much you want to pay for it. The investment funds are getting involved in a major way, primarily. It happened again with CMBS. You saw how big that the originations were, and then the special servicers, the guys in the B piece, the first loss position, they started the online open listing format of auctions so that they could prove a market while also being in touch with where the bids were to determine whether, hey, I want to double down like blackjack. Hey, I'm in the B piece, first loss position. I want to double down, right? So then they would buy the asset and even bid on it, right? Or take it back to the servicer or to the DCH to determine whether they sell. Investment funds, so that's kind of where they started, and now they're branching off, and now they're buying. Right? That's how Starwood got, and Barry Stern got started, right? Buying distressed asset. Now they all have their funds. Right now, I just read Sam Zell. He can't find enough distressed opportunities. He's overpaying for bigger assets. It's like whatever, because he focused on the management side. But the investment funds are there. They have a ton of liquidity. Yes, you can sell Mpls at premium. We'll get in that next, but they're out there and they're bidding on SFR now. So that's where your users are going to be either looking to sell out to them or potentially competing with them when you get 5 or more, and typically $1 million and higher. but they're going below $1 million. That only started maybe 6 months ago, and they are paying a lot. They got cheapest cost of capital. So if you're working with a fund or investor, know where their funds come from and always get proof of funds. Right? Hey, your investment funds. So what's your proof of funds?
But also make sure that it's actually a true qualified funder or investor, not a joker broker. I got 20 million every month. I hate hearing that. And my comment is, hey, well, let me have your QIB form. You know what I mean? Go from there.
Yeah, I probably didn't hit on that enough. Stay off the daisy chain. Whatever you do, stay off the daisy chain. Don't go chasing waterfalls. Stay off stick to rivers and streams and the asset types and lenders that you're used to, man.
We got a little hip hop going here. Good stuff there.
Yeah. Oh shoot,
Mike, we got about 5 minutes left here, buddy.
Okay, I'll hurry this up. So owner users, they're going to be more involved in hotel and owner operators. Developers, they're going to be looking at hotels specifically to convert them and office properties, and mostly CMBS, to look to convert them over into multifamily or tech suites. It's already happening in places like Florida where they're going and buying these 2-story motels and converting them into millennial apartments, right? So that's a trend that just developed very recently. There's a lot of capital for that. Lenders, bridge lenders who cannot originate enough loans, they will go in and buy the loan and then get one of their borrowers that they have a good relationship with to turn it around. I've done those deals myself where the borrower was recommended to us by the lender. Or the buyer, sorry. So how to sell Mpls at a premium. This is gonna be really quick. So there's 4 main things, 4 must-haves, one really great to have. Obviously the 5th one is us, Exchange.Loans, my shameless plug here. Recapitalizing assets, opportunities, and communities is the core mission and focus of the Exchange.Loans platform, the online marketplace for non-performing loans. So we give you guys a secure and open environment to do that in. So number one thing you want to look for determining whether an NPL can sell above its UPB. The value has to be greater. The value of the asset, the underlying collateral, has to be greater than the payoff amount, total payoff amount that they quote you, which also has to be significantly higher than the UPB. Why is that? Because you need significant equity above the total payoff and above the UPB in order to pay above par, and you have to have a clear path to title. Right? Hey, this guy's in default. There's no dispute. Maybe I have to fight it in court. Cool. Is there enough equity in there to validate me spending that good money to go after title? Otherwise, it's good chasing bad, if that makes sense. So if you only got about $10,000 or $20,000 of equity in a deal, you're gonna have to be really careful with your cost and with your strategy to go take that title and gain that equity to make it worthwhile. You're going to have more liquidity and more equity in a marketplace in the top 100 MSAs. If you're outside of that, you've got to price that into your exit strategy, as well as even getting to title, but that goes more to the next sides. But I just want to backtrack there again. Top 100 MSAs, core markets. You can go outside of that. It's just going to be way harder. I wouldn't suggest it if you're trying to get par or premium to UPB. So if you're out there pitching to lenders, try to focus in those markets with collateral in those markets. Also focus on liens where a non-judicial foreclosure option is available. So obviously non-judicial jurisdictions. So stay out of Brooklyn, stay out of Cook County, stay out of New Jersey. If I can just stay out of there, and you should be able to maximize those recoverable value or even offer more. Or if you're in those places, know that you have a non-judicial foreclosure or path to title, right? Non-judicial. So hey, I already have the summary judgment. I have the deed in lieu signed by the borrower. So I'm there. So if you have those 4 things, you can sell at par and premium, and we've been doing it. We've got case studies if you guys want to go through it. I'll stop the share there. I hope that was a bit smoother than last year. And I'm here for any questions if you guys got it.
You aren't talking near as fast as we were last time because you didn't slam 3 Red Bulls or 3 coffees right
Yeah, triple espresso, man. I'm hurting for my coffee now, so I'm a bit tired. So
well, hey man, that was great stuff. Now, one of the big things, you guys have assets available for sale. People are looking on there, but also one of the things, if people are reaching out to asset managers, you will assist people in helping them buy it, move it, or pay them a bird dog fee or anything like that too?
So, okay, so this is really good. I probably could have put more pitch in there. We're getting out of MVP mode into, haven't even officially launched. We're actually officially launching next week. Come hell or high water, I'll be at, at the Dre's going to be the one presenting at these big conferences though, at the IMN down in Dana Point, California. So that's where all the bank special servicers get together to discuss what the heck's going on. So what can we do for you and your users? What's in it for you guys? So yes, we primarily operated as a loan sale advisor. So then I would go sell it. We can share referrals. We usually do 80-20 back and forth. You give me a deal, I do all the work, I sell it, I'll give you 20% referral, and vice versa. So if you want to work that way and let us do all the heavy lifting, or et cetera, so this is a new announcement. Again, I'm announced because I announced Exchange.Loans on your the No Camp last year. So the big announcement this year, we're coming with a way for you guys to sell your loans yourself on our platform. There's two ways we're going to do that. One's called Lender Direct. So if you got a loan, whether it's performing, subperforming, non-performing, or what have you, you can sell it yourself. You're paying a subscription to list, just like LoopNet, just like CoStar. It ain't free because we're the only ones doing it. You don't have to go through DebtX. You don't have to pay a broker. You don't have to pay an auction. So that 5 to 10% transaction fee, if you're the lender, you get to go Lender Direct, only on Exchange.Loans. And then for brokers, the next product we're developing hopefully later this year, it's called XL Pro. So you subscribe just like Cre Pro, or just like a CoStar, just like a LoopNet. I shouldn't even be saying those names because I'll probably get sued. You can go on there and you can list for third parties, and you can do all the work. You control and you control it. You set the fees. We're not asking for a piece of your fee or commission split or referral. We do intend on having automated bid deposits to verify and ensure the certainty of the transaction execution, that everyone's playing fairly. We got everything. We got 2-tier data vaults with full digital rights management by file share. So we built it all. And in terms of sharing leads, that's way down the road. I don't know if I'm going to get that this year. I still want to get through all of them myself. But yeah, so we can sell it for your lender. You can sell on our site, and you can also sell Lender Direct. So
Awesome, man. I love it, Mike. Looking forward to it. Great stuff, man. As
thank you.
always. Now that we're able to travel a little bit, we need to get together. I may see you down in Dana Point and IMN or something like that. All right,
I
brother?
would like to. I'll probably be getting to Texas sometimes as I continue traveling all over. I'm hitting the West Coast next.
Well,
So.
you may make sense to come in. We got FinCon taking place here in Austin later in a few months. So.
Oh yeah.
Yeah.
All right. Yeah, I've been really interested in Austin since now I'm more focused on the tech thing and scaling my biz now that I've actually got like proof of concept, all that good stuff. But want to get those. Looking forward. Thanks for having me. Really appreciate, Scott. Really love the No Camp and all the feedback and people reaching out. Feel free. I'm here as a resource, and hope to see you guys on Exchange.Loans soon.
Thanks, Mike. Appreciate it. Have a great rest of the week. Okay.
You too. Take care.